Good morning and welcome. Welcome to those of you that are here in the room, and welcome, of course, to our online guests as well. We really do appreciate you taking the time to be here today. On behalf of the Saskatchewan Workers Compensation Board, welcome to the rate-setting consultations for the 2015 premium year. I'd also like to welcome you this morning on behalf of your board members, Employer Representative Karen Smith and Worker Representative Marg Romano. And they're seated there. Ladies, just stand and give a wave to everybody so they know who you are. Perfect. This morning should last about 2 hours. Unless you have so many questions, we'll be here as long as you want to ask questions. How's that, Peter?
Sure.
Okay, good enough. At the conclusion of my remarks, our CEO, Peter Federko, will be taking us through the preliminary premium rates in much more detail. We will be explaining how we go through the rate-setting process and our premium rate composition. We will provide information on our financial position, prevention strategy, and then we will give a look at some of the things we have planned for 2015. There are also members of the WCB executive team here and staff to answer questions that you might have. The discussion period will be open to online and in-person guests. And as Carolyn briefly mentioned before, please hold your questions until the end of the presentation. These meetings are an annual part of our rate-setting process. We believe they are crucial to our accountability to you, our customer. They are also an important venue for you to provide feedback on our proposed rates. If you'd like to learn more about what we do, I'd also like to invite you to attend our annual Compensation Institute being held in Saskatoon in March, and our annual general meetings in May, held in both Regina and Saskatoon. If you'd like more detailed information, we'll be tabling, as usual, our annual report in the spring. We also publish an annual stakeholder report that provides a comprehensive overview of our annual activities. Before I came to the Workers' Compensation Board, I held a number of jobs, and I could probably bore you for an hour or so telling you about all what I've done, but I'm not going to do that. I'll just mention a couple of things. I worked in sales, and I was in business. So I know that when you put up a slide that says vision statement or company mandate, that's probably a code for everyone's eyes to glaze over. Or everyone check your phone under the table. But with regards to the vision statement, Peter and I asked for this slide to be here for a reason. Not so that you'd have a minute to check your phone under the table, but we asked for it because our staff, our WCB lives this vision statement. If you ask our employees, they can tell you what it is. They embody this in their daily interactions with our customers and in the ideas they put forward to Peter and his executive team to make things better for our customers, you, the employers, and workers. Having these meetings as large general sessions, being live broadcast, and having this video available online all came about because our staff and the WCB executive want to continuously improve the service they provide to you, our customer. Their efforts to be good stewards for your funds mean that we continue to have one of the lowest premium rates in the nation. And that brings me to our next slide, our premium rate history and the 2015 preliminary average premium rate. We are pleased this morning to announce the preliminary average premium rate for 2015 is $1.46. This is our lowest rate in nearly 3 decades, 29 years to be exact. Here's a slide illustrating the average premium rate history and its downward trend. Since 2004, when our average employer premium peaked at $2.05, we've seen a series of decreases that have resulted in a 59 cent or 29% drop. In 2014, the average premium rate was $1.51. This was the lowest rate we had seen since 1987, when the rate was $1.48. We've now surpassed that. Some of our compensation board counterparts have announced their 2015 average premium. Others will be letting employers know their 2015 premium plans in the next few weeks. As the chart shows, Quebec is lowering its average premium rate in 2015. Nova Scotia and British Columbia are maintaining their average premium rates. With that, I'll now turn it over to Peter for a more detailed presentation of this morning. So thank you, ladies and gentlemen, and again, thank you for being here.
Thank you, Gord. Firstly, I just want to join with Gord in welcoming you all here this morning and thanking you for your participation in this event. Our objective, as Gord said, in introducing the live streaming to you this morning, as well as holding these broader general sessions in both Regina and Saskatoon, is really to make more stakeholders, more employers and workers aware of the mystery that goes into establishing premium rates at the Workers' Compensation Board. The fundamental question sometimes that particularly new employers ask is, why am I paying workers' compensation premiums anyway? And prior to, in Canada anyways, prior to 1913, the only recourse for a worker who was injured on the job was to actually sue the employer. And most workers were not successful in actually suing their employer, and accordingly, they generally fell to the state or the province to look after them. In other words, they had to fall back on the social safety net systems, being social services or welfare or whatever the case was back in the day. So starting in Ontario in 1910, they appointed a guy by the name of Judge William Meredith, who since became a Sir William Meredith, and he studied compensation systems around the world and established the compensation system that we have in Canada today based on something he referred to as the historic compromise. And that compromise was that employers guaranteed that they would continue to pay for the cost of any wage loss and medical associated with a workplace injury, in exchange for which workers would give up their rights to sue those employers. It was a no-fault compensation system that he envisioned. He envisioned a collective liability where employers together would share the risks and costs associated with workplace injuries, and he envisioned a compensation system run by an independent board that had exclusive jurisdiction to determine all matters under the legislation, because he did not want it to be based on whatever the political whims of the day were, but rather an independent board that would make decisions with respect to injury claims on the basis of the evidence that supported whether it was work-related or not. Your premiums, the premiums that are paid into the compensation system, are to fund the entire system, while my board members are appointed by order in council. We are not part of executive government. We receive no money from government. We pay no money into government, so we are not a crown. We are an agency created by a piece of legislation that survives on the premiums that we collect and any earnings that we earn off the investment portfolio. So this slide is probably key to understanding how premium rates are established or what those premium rates represent. And really, it's two key things: claims costs and payroll, that go into the calculation of premium rates. Premium rate is just a ratio of costs divided by the base, which is payroll, and a premium is submitted per $100 of payroll accordingly. Now, the two key things that go into the determination of claims costs are firstly the number of claims, the frequency of injury. And we use an indicator that we call the injury rate to give us an indication of whether workplaces are getting relatively more safe or less safe. The other factor that impacts compensation costs is the length of time that people are on compensation. The severity of the injury, the effectiveness of the return to work processes, or whatever the case may be. And the indicator we use there is what we call durations. The average duration, how long on average an individual stays on workers' compensation before they go back to work. So looking at the injury rate, the first indicator that feeds into the calculation of premium rates, you'll see that the trend with respect to the injury rate, now the blue line represents the total injury rate. So these are all claims, whether there's lost time associated with them or not. So some claims only require medical attention. You go to the doctor, you receive some stitches, you return to work the very next day. Those are considered no time loss claims. The other claims, which is represented by the gold bars, are what we call the time loss claims. And those are claims that are the result of an injury serious enough to take the worker out of the workplace for at least 1 day beyond the day of injury. Now, back in 2002, the time loss injury rate was running at somewhere around 4.95%. Just about 5% of workers in the province were having an injury severe enough to take them away from work beyond the day of the injury. You can see that that has steadily declined, so that when we ended up the year 2013, the time loss injury rate was sitting at 2.54%, almost a 50% reduction in the number, in the rate with which workers were having that kind of injury. On the other hand, the total injury rate, all claims included, whether lost time or not, also declined down to 7.11%. Significant decreases, significant importance in terms of trend relative to the decrease. Now, one thing you may notice is a slight bump in the time loss injury rate in 2014. So this is based on what we've seen to the end of the third quarter, so the end of September 2013, or 2014, and then projecting out to the end of 2014, we are seeing a slight bump in the time loss injury rate going up to 2.56%, but a nice decline in the overall injury rate dropping down to 7.11%. So what at the end of the day does this all mean? Well, from 2002, when we were at 4.95%, to the end of 2013 at 2.54%, there's over 5,000 claims that have been taken out of the system, because we believe of the effectiveness of injury prevention programs in this province. A time loss claim runs on average about $10,000. So if you take 5,000 claims out of the system at an average cost of $10,000, all other things being equal, ignoring inflation and all those other things, you would expect to see $50 million less in the system spent in 2013 than what we were spending in 2002. And I can tell you the total number of compensation days has dropped as well, and I'll get to that in a minute when I talk about durations. When we add up the cumulative effect of the continuous reduction in the number of injuries over that period of time from 2002 to 2013, it's over $110 million in terms of costs that have been taken out of the system over that 12-year period. When we look at claim durations, now this is just the average number of days on a rolling 12-month basis. So this is a 12-month window. This would be as of December 31st. This is projected based on September 30th. So you'll see that durations have basically been flat, sitting at roughly 34 days. We saw a bump in durations in 2002. Some of that had to do with us getting familiar with the new claims management system, and we saw a little bit of a bump in terms of durations. As we got more accustomed to that, we saw that level back off down to around that 34, 35-day period. And now we've seen a slight bump in 2014. Now, several things can impact durations. One of the things we discovered a few years ago is simply the mix of claims that are now in the system has the effect of changing the average duration. So what's happening from an injury prevention perspective likely is that the less severe injuries are the ones that are being prevented, and what's left in the system are the more severe injuries, and accordingly the simple average goes up as a result of that. We had an actuarial analysis done in 2012 and determined that the effect of the changing demographics of claims in our system is 3 days on average. So if we took 3 days off of that 37 days, we'd be sitting again somewhere around that 35-day duration number. Now, injury severity itself can change the claim. So depending on the demographics of the claim, we can see more severe injuries in the system, and accordingly that drives up the compensation durations. When we look at the number of claims accepted, so I showed you the injury rates, and that's just the calculation of number of claims divided by our estimate of the full-time equivalents, the number of people working in the province covered by workers' compensation. So as you probably know, we don't actually get number of employees reported to us. We only get total payroll reported to us. So using average industrial wage, we estimate the number of full-time equivalents. Taking that full-time equivalent number and dividing it by the number of claims gives us the injury rates. But you'll see, as I was saying earlier, the absolute reduction in time loss claims from 2009, the last 5 years, to the end of the last fully completed year, 2013, we're down about 2,000 time loss claims. No time loss claims, pardon me, actually saw a bit of a bump between 2009 and 2013. But if you take the combined total of total claims, you'll see that there has been that trend of steady reduction in claims over the years. I told you we are forecasting a slight bump in that time loss injury rate. That translates into almost an additional 500 time loss claims that we're seeing come into the system in 2014. A nice reduction, however, in terms of the no time loss claims, so our total claims, again, are decreasing. In terms of claims distribution, so I talked a little bit about claims severity affecting the durations that we pay. So if the mix of the claims changes over time such that we're getting more serious injuries in our system, that's going to impact the average durations. What we have here is a 5-year average of the kinds of claims that we come into the system, that we get into the system. The blue line represents the number of claims, and the gold bar represents the cost associated with those claims. So in general terms, this demographic hasn't changed a lot. So if you were to look at this slide from 5 years ago, you would see that the most frequent type of injury that we get is actually a hand injury, but the costs associated with that hand injury are very, very small. On the other hand, back injuries, being the second most frequent type of injury that we receive, has very, very, very high costs associated with them. The third most frequent injury are leg injuries, and they have a relatively high cost, particularly if you look at hand injuries in particular. Now, I had a look at last year's slide just for the fun of it, and while not a great change in this demographic, what has happened is the frequency of back injuries has bumped up from about 21% to almost, to about 14% to almost 17% in 2013. Hand injuries, on the other hand, bumped down a little bit. They were running around 22% last year. They're down around 20%. So we are seeing, when we look at the claim distributions, we are seeing a slight change in terms of the demographic, the type of the claims that we're getting into the system, which validates for us our contention that the severity of injuries that just due to the mix of claims is actually changing. When we look at the costs associated with the claims that we have paid, the blue bar represents the healthcare costs, the gold bar, the compensation costs. So these are actually the short-term wage loss claims. Earnings replacement are the long-term wage loss costs associated with a claim, survivor benefits, and vocational rehabilitation. And you'll see that there is a nice trend, with the exception of healthcare costs, which continue to increase. There's a nice trend with respect to the compensation costs of a leveling off of the overall compensation costs associated with these claims. Now, when you look at the wage loss payments, you will see a bump from about $62 million in 2013 to just over $68 million in our estimate for 2014. Now, part of this has to do with us catching up on what we call interjurisdictional claims. So if a worker resident in Saskatchewan is working in one of our neighboring jurisdictions and has an injury, they can claim in that particular jurisdiction. That jurisdiction will adjudicate that claim, will pay that claim, and then will send us a bill for the costs associated with that claim, and we reimburse that jurisdiction. The same is true the other way around. If an Alberta worker is injured in Saskatchewan and we pay the claim, but the premium was paid in Alberta, we will bill Alberta Board back for the costs associated with that. As we implemented the new claims management system, we got somewhat behind in terms of payment of our interjurisdictional claims. We had the opportunity to catch up in 2014, and so there's over $4 million in additional costs that really should have been attributed to 2013 that made their way into 2014. So when you make that correction, again, you will see that the trend overall, so this would become roughly $65 million, this would become $65 million, relatively flat with respect to overall compensation costs. So the second element, so we just looked at compensation costs. So these, what we're seeing in terms of experience here, will go into the calculation of premium rates for 2015. So remember, what we're talking about here today is setting the premium rate for brand new injuries that will occur in 2015. This doesn't have anything to do with ongoing payments for claims from 2013 or 14 or any years prior. What we're doing is we're estimating the injuries and costs associated with those injuries for brand new claims that we will get in 2015. We use what we're seeing in terms of current cost trends to feed into that part of the calculation of the premium rate, being the overall compensation costs. The next element which determines the premium rate is the base. Over what base do we have to collect that amount of cost? And that's payroll. And you'll see we've seen significant growth in the amount of payroll reported to us over the years. If I go back to 2002 again, which is kind of our benchmark year because that's when we started aggressively on the injury prevention front, our payroll has basically doubled. It was about $9.5 billion in 2002. We are sitting at $20 billion at the end of 2014. Significant increase as a result of the economic growth and activity in this province. Almost 100,000 more FTEs, according to our calculation, working today than were working in 2002. Over the last 5 years, over 40,000 additional full-time equivalents working in this province. So that simply increases the base, which helps to mitigate what the average premium is going to be because you're collecting it over a larger base. Based on payroll estimates that we get from you people, payroll revision statements, trends that we see in the economy, we are forecasting an increase in the 2015 payroll of about 5.5%. Now, just over a point of that, about 1.2% of that is attributed to the change in legislation that took place January 1, 2014. So January 1, 2014, our maximum insurable increased because of a change in legislation that came into effect. As a result of larger wage insurance base, if you will, a larger maximum insurable, that has the effect of increasing the payroll reported to us. 1.2% of that 5.5% projected goes into this $21.15 million. When we were standing here about this time last year talking to you, we were forecasting about $20.8 billion in payroll. There has been a slight correction at just over $20 billion. somewhat of a slowdown. We were forecasting over 10% growth in payroll last year. It's coming in closer to that 7-8% for 2014. On the conservative side, we've gone with the 2015 sitting at 21.1, and maybe good given what's happening with oil prices and so on and so forth around the world. So we get the cost numbers, we get the payroll numbers, and now we have to apply that somehow to the industries in this province. So we have about 45,000 employers that we cover today, working in various industries across this province. While Meredith said employers need to collectively share in the risks and costs of the compensation system, our legislation says it should be applied on the basis of industrial undertaking. What are the fundamental underlying businesses that employers are engaged in that would have similar risks? Those should be grouped together, and they should collectively share in the risks and the costs of that particular industry. So we take those 45,000 plus employers and we divide them into what we call 50 rate codes based on the industry that they're in. So construction trades are all grouped together, commercial, industrial, and construction's together, all bankers are together, accountants and lawyers, so on and so forth. So we take that whole group, we divide them into these 50 groups, and proceed to establish the premium rate for every one of those particular industry codes. What we are attempting to do, as I said earlier, is collect enough money today, well, starting January 1st, 2015, to pay for all of the costs associated with all of the claims that we will receive in 2015. One of the underlying principles in our legislation is that today's employers should pay for the cost of today's injuries, so that tomorrow's employers, who might be brand new into the industry, aren't bearing costs of injuries that occurred in years gone by. And so that's what we are attempting to do, estimate the total costs of all the claims that we're going to get into the system in 2015. Now, after we calculate that base industry rate, in order to reduce essentially cross-subsidization, in other words, have employers who have good safety records pay for employers who have bad safety records, we introduce something called an experience rating program. And the experience rating program simply compares individual employers in each of those 50 industry groups with the average for that industry group. I'm oversimplifying, but I think you'll get my drift. If you're better than the average for your industry group, you're going to get a discount. If you're worse than the average for your industry group, you're going to get a surcharge and pay additional. And it's to try and balance, again, the actual experience of individual employers against the collective experience of that particular rate code. So the model that we use in order to do all this forecasting really looks at trends and historical spending patterns to help us determine what next year's experience is going to be. So when it comes to wage loss for compensation payments, for earnings replacement payments, we generally look at the last 5 years of experience to help us forecast what next year's experience is going to be. As it relates to healthcare and vocational rehabilitation, because healthcare has been growing exponentially relative to overall inflation, we look at the last 3 years of experience for healthcare, believing that that's going to be more representative of the future than going 5 years back. We then project the number of claims that we expect to see next year, again, based on what we've seen so far, what we're forecasting to the end of 2014, and anything else that we might learn from you or from other economic trend indicators relative to what might be happening with injuries. We then calculate the future costs of all of those claims over 50 years. So we can have workers, well, really, I guess as young as 14 now in Saskatchewan, but 15, we can have workers for sure working at the age of 15. Compensation benefits end at age 65. And so we look at trying to cover all of the costs of potential claims from the age of 15 to 65 over an entire 50-year period. Now, we have had employers question us in terms of the reactiveness of our rate-making model, suggesting that using 5 years of experience and ignoring current year experience is not giving employers full credit for what might actually be happening in their particular workplaces. The idea of using kind of 5-year and 3-year averaging is to take seasonal or untypical trends out of the calculation of what the premium rate needs to be. So if you have 1 year of good or bad experience, the model's not going to react immediately until it recognizes that there is now a new sustainable trend. So I showed you a few slides ago how we are seeing an uptick in the number of time loss claims in 2014, a bump in the time loss injury rate. The model will not react, as you can see from the average rate that Gord showed you. The model will not react by suddenly saying, oh my God, we have to increase the premium rate because we're seeing a slight bump in time loss claims. So it has the effect of smoothing the experience and taking out what you often had referred to as rate shock, providing some stability in the premium rate and not knee-jerk reacting just because you have a 1 year in a row experience of one nature or another. The industry premium rate then just falls out as a mathematical calculation. We determine the cost based on, again, historical spending patterns. We take premium estimates that you folks provide us and other things that we can learn from economic and industry trends. We calculate the current cost of those claims in terms of present value dollars, and we simply divide it then by the amount of payroll in order to come up with what our premium rate is. As I said earlier, once that industry premium rate has been established, we then experience rate every individual employer in those industry codes. It takes out, mitigates that cross-subsidization that I referred to before, plus hopefully provides for an incentive for employers to invest in injury prevention and return to work so that they are no longer not as good as the average for their particular industry. So the fundamental premise is employers who cost the system more will pay more. And in 2014, 24,600 employers are going to have received premium rebates, discounts as a result of the experience rating program totaling over $25 million. On the other hand, almost 1,600 employers are going to pay $22.6 million in surcharges. We made a commitment when we introduced the experience rating model to have that reviewed every 3 or 4 years. We assembled a stakeholder committee in 2014. That committee has concluded their deliberations, have not yet finalized their recommendations, and so we don't know exactly what they might be suggesting in terms of changes to the experience rating program, but we expect to receive that report from them in the next few weeks, and then the board can make a determination what, if any, changes need to be made to the experience rating program. This took a little bit longer than we had hoped. When I talked to you last year about this, we were hoping that we would have the experience rating program reviewed and any changes actually implemented for 2015. It doesn't look like that's going to be possible, and so we are now targeting January 1, 2016 for implementation of the recommendations coming out of the experience rating committee. The experience rating program is split into 2 programs. One called the standard program, one called the advanced program. And it's really to try and differentiate between the small and the large employer. So if you've paid us premiums of less, cumulative premiums of less than $15,000 over the last 3 years, you go into what we call the standard program. The standard program is frequency-based. It's based on the number of claims that you have, not the costs associated with them. And according to a sliding scale, you can receive a maximum discount of 25% if your performance is actually better than your industry, or you can receive a surcharge of up to 75% if you're worse than the average for your industry. If you've paid us $15,000 or more in premium over the last 3 years, you go into our advanced program. That advanced program is cost-based. The maximum discount there is 30%. The maximum surcharge is 200%. So if our premium rate was $1, you could receive up to a 30% discount. You would be paying 70 cents after the experience rating program. So if the dollar was your industry rate and you got experience rated and got maximum discount, you would only be paying 70 cents. On the other hand, if your experience is not as positive as the average for your industry, you could receive a surcharge of up to 200% and you'd be paying $3. So the band in the advanced program is between, in my example, 70 cents and $3 ought to be enough incentive for those employers who are outside of the norm for their industry to actually invest in health and safety and return to work so that their experience can come down to where the industry is in general. We actually stratify our premium rates, and I'll show you that slide in a minute, so you can actually see the contribution that every type of benefit has toward the premium. But you'll see that the majority of what goes into the calculation of the premium is actually the claims costs. 74% of the premium is driven by direct claims costs, 8% by investment in health and safety, which includes the amount that we provide to Occupational Health and Safety Division in Labor Relations Workplace Safety. So 82% goes either to claims costs or injury prevention, and 18% goes to the running of the compensation system, the administration of the WCB. So the actual compensation from the slide, you can actually see the various elements that go into the calculation. And you'll see that overall claims cost element drops from $1.13 to $1.08. And every category, with the exception of fatalities, within the claims costs overall grouping is projected to decrease in 2015. For fatality averaging, we use a 5-year back average. And some of you may recall 2 years ago, we unfortunately reported 60 fatalities in our province. In 2010, we had 44 fatalities. So some of those fatality averaging costs continue to work their way through the system. We are now seeing, the impacts of that in bumping the actual element up relative to fatality benefits provided in the system. Administration dropping a small amount. The funding of the safety associations going up by just a few cents. We do have industry-based safety associations, and while I'm showing you the average impact relative to safety association funding on the average premium rate, not all employers actually pay 5 cents toward the funding of the safety associations. The Construction Safety Association is funded by some allocation for the Construction Safety Association, and only construction employers will pay a contribution toward funding of that safety association. So it's very industry specific, but we just feel it's necessary to show you the overall impact on the average premium rate if all employers in fact did pay that. So as Gord indicated earlier, we're very pleased to be able to share with you a further reduction in the premium rate down from $1.51 in 2014 to on average $1.46. Now in prior years I've said no employer will actually pay $1.46. Coincidentally, we actually have one rate code this year whose industry rate is going to equal $1.46, but it is purely coincidental. So this simply represents the average premium for all 50 rate codes that we have within our compensation system. Accordingly, 89%, 42,000 employers are going to see their premium rate either stay the same or drop. 11%, or roughly 5,000, are going to see their premium rate increase. After we apply the experience rating, that changes. Now we only have roughly 38,000, or about 82% of employers, who are going to either have no rate change or a decrease. We're going to now see a category of employers who are going to see their rate go up by more than 10.5%. Another group who are going to see their rate go up by about between less than 10.5%, between 10 and 1%. And then there's a certain group that aren't eligible for the experience rating program. For example, you have to be in business for 3 years before you're actually eligible for the experience rating program. So there is a category of employers who will not be subject to the experience rating program in 2015 at all. The point of the illustration is, when we look at the base premium rates, it has this effect on employers of the province. When we look at the experience rate after application of the experience rating, it actually does change the demographics. Employers do shift out of, I guess, an average industry rate position to something either better or worse as a result of applying the experience rating program. By the way, the number of employers receiving discounts this year has increased quite substantially, and it has increased over the years. And the number of employers who are receiving surcharges while they're paying, a substantial amount. Remember, 24 million we're collecting over a very large group of employers, over 24,000 employers, and only 1,600 employers are actually paying us $22 million. There is a significant difference between the average premium rate for the industry group and what the experience rate will be. We just want to now share with you a really quick snapshot of what our results look like to the end of September. So as of September, we are seeing premium revenue slightly below where we were at in 2013. And while we've seen a growth in payroll, you'll know that that growth, as I showed you earlier, is actually somewhat muted from what we had forecast when we set the 2014 premium rate. So we had a drop in that premium rate down to $1.51 last year, slightly lower payroll than what we forecast, and so total premium revenue is coming a little bit under where we were at the end of 2014. Claims costs, this is a bit of an anomaly as well, showing a fairly significant increase in claims costs, even though the trend slide that I showed you earlier shows a flattening of it. Some of you may recall last year when we talked about this, and again at our annual general meeting this spring, that there was a new actuarial requirement introduced that is going to take effect January 1, 2015. What we're required to do is build into our liability an amount to fund future occupational diseases, so claims that we don't know about. We had reserved, at the end of 2013, we had reserved $85 million in order to cover the anticipated cost of that occupational disease liability. And what we're doing in 2014, because we will have to record that liability at the end of 2014, is we're actually including 1/12 of that $85 million, which at the end of September is around $64 million in that claims cost. So if we were to back the effect of that occupational disease liability out of this, you would actually see a decrease in the overall claims costs. Our administration costs, very flat. Safety and prevention, which includes funding of safety associations, occupational health and safety, and our WorkSafe budget, a slight increase over last year. Annuity fund interest, that's just interest that's earned on annuity funds we set aside for workers who are on compensation for 24 consecutive months or longer. And then our legislative obligations are to fund the Office of the Workers' Advocates, as well as pay for our legislative review process, referred to as the Committee of Review. So when we take total premium revenue and we minus total cost, we come up with something called an underwriting profit or loss. So this is simply a difference between the premium collected in that particular year and the total costs in that particular year associated with claims, not just from that year. So what's in these claims costs are all claims paid in 2014, not just 2014 claims. This is premium only collected to fund 2014 claims. So there is a bit of a disconnect. So what you would have to do in order to look at this and determine are premiums covering costs or not is you'd have to look at this over a longer period of time. And we go through something on an annual basis called the rate reconciliation process, where we compare cumulative premiums collected with cumulative costs. And we are running a bit of an underwriting surplus at the end of 2014 if our projections hold true to the end of the year. After we calculate our underwriting profit or loss, we then add in our investment income. Investment markets, with the exception of the last couple of weeks, have been incredibly strong again in 2014, reporting substantial investment income of $128.3 million to the end of September. Now, I can tell you, as a result of the volatility in the markets over the last couple of weeks, we've probably lost between 10 and 12% of market value over that particular period of time. Our investment portfolio is sitting at about $1.9 billion. So there will be, in the last quarter, we're anticipating somewhat of a correction. As a matter of fact, when we did our projections to the end of the year, we assumed no growth in terms of the market value of our investments for the last quarter of 2014, just because we don't know, what the markets are actually going to do in this particular last quarter. We could see a bump up, we could see a bump down, but as we've set our projections out, we're assuming that what we got to the end of September is what we're going to have to the end of December. So total income reported to the end of September 2014 is sitting at $52 million compared to $98 million that we reported last year. This next slide simply, question that we get again has to do with the amount of money that we're sitting in reserves. Why do we need to have these reserves? What are you doing with that money? So on and so forth. So there were a couple of significant events that happened over the last couple of years. One of them I already talked about, and that's the need to fund an occupational disease liability by the end of December 31st, 2014. The second was new legislation introduced on January 1st, 2014. And the most significant piece of that new legislation was increasing the maximum insurable, the maximum compensable wage base. In the case of claims prior to January 1, 2014, the maximum went from $55,000 to $59,000, and that amount is now being indexed by the change in provincial average wage. New claims from January 1st, 2014 on, the maximum was sitting somewhere around $61,000. It's now forecast for January 1, 2015 to come in at around $65,000 maximum compensable and insurable. In order to pay the costs of that new legislation, of the increase in the maximum insurable on claims in the system as at December 31st, 2013, we had to fund about $83.5 million in additional liability. And so we set aside money back in 2012 in order to cover this new legislation that was coming on. If we had not set that money aside in order to cover the new legislation, it effectively would have added 40 cents to the premium rate. Similarly, if we had not reserved that $85 million in occupational disease reserve over the last 3 years, we would be looking at needing to add 40 cents to the premium rate this year. The experience rating program, as I showed you earlier, we're paying out about $24 million in discounts and only collecting about $22 million in surcharges. That $2 million difference would amount to about a penny on the premium rate if we funded it out of the premium rate. Instead, what we've done is we've taken that out of the reserves that we set up for the occupational disease and the new legislation and our injury fund. and don't have to build that into the base premium rate. Because what we want the premium rate to reflect is the true cost of insurance, not things that impact us as a result of new actuarial standards or new legislation that might come in place. So we were able to take that entire 81 cents out of reserves that we've previously been able to set aside out of surplus investment earnings and hold the rate at $1.46. So when we look at our overall funded position, we have a funding policy at the board that says at all times we need to maintain a surplus in our injury fund of between 5 and 20% of the benefit liability. So our benefit liability is running over $1 billion. At the high end, we would need $200 million roughly sitting in our injury fund. At the low end, we would need $50 million sitting in the injury fund at all times in order to prevent us from going into an underfunded position, ensuring that we have enough money to pay all claims that are in the system to the conclusion of those claims. And you'll see the funding percentage, which is simply the injury fund divided by the total liabilities, was down about 111% in 2010. We are now seeing, based on September 30th, 2014 results, we're sitting at almost 122%, just over 122% funded position at the end of September. What our funding policy says is if we exceed that 120% upward threshold, we begin rebating money back to employers to bring us back down within this range. If we ever drop below 105%, we would be seeking to recover money from employers through premium increases to put us back in this range. Now this is based, as I said, on September 30th results, with that $128 million sitting in our investment income. Holding returns to where they are at the end of September 30th, when we forecast that out to the end of the year, so assuming fourth quarter, adds no value, we would be sitting just right around the 120% mark. So you shouldn't go to the bank and start depositing checks. You shouldn't go out and buy a new car just yet because we don't know really where the year's going to end out and whether rebates will be forthcoming in 2015 or not. But that could be possible if that funding ratio is maintained. What these strong investment markets over the last 3 or 4 years have allowed us to do, and great management by our investment managers, is to establish that funded position, allow us to fund the liabilities, allow us to pay for increased benefits without having to increase premium rates. We've been able to drop those premium rates, still cover the costs associated with all of the claims in the system based on new legislation, on new actuarial standards, and possibly be in a position to rebate money back in 2015. It's really going to be dependent, however, on what happens with investment markets in the last quarter of the year. I want to spend a few minutes now just talking about our injury prevention initiatives. Back in 2002, we formed a partnership with the Ministry of Labor back in the day, Labor Relations, Workplace Safety today, and we called it WorkSafe Saskatchewan. Workers' Compensation Board actually does not have mandate for health and safety. That resides within the Occupational Health and Safety Division. However, when injuries occur, they end up on our doorstep. And we're the ones who have to pay those claims. We're the ones who have to calculate the premium rates. And so we got aggressively involved in injury prevention back in 2002 and found it important for us to have this partnership with the organization that actually had the legal mandate to do enforcement and regulation. Because we wanted to create a broad injury prevention strategy for our province. You can't have good injury prevention without having good enforcement, without having good regulations that support what the overall strategy ought to be. That partnership continues to exist today. You can go to the WorkSafe website. You can actually see WorkSafe's strategic and operational plan, its results over the years, of what we are achieving with respect to the partnership that we've created between the ministry, but all of the other partnerships that we have with many employer and labor organizations in this province. Nothing we achieve would be possible without positive relationships with our stakeholders, the employers and workers of this province. We have over 30 partnerships with Federation of Labor, Saskatchewan Building Trades, the Chambers of Commerce, the CFIB, Saskatchewan Brain Injury Association. I mean, I could go on, CNIB, to drive home the injury prevention message by having them become advocates for injury prevention as we are. Because then the credibility of the program, the importance of that message, we believe truly rings through with the remainder of the stakeholders. We also have targeting strategies. We seek out, looking at the claim demographics, we seek out the kinds of claims that we're seeing and try and develop injury prevention programs to prevent back injuries. We partnered with the Chiropractic Association last year and ran a campaign to try and reduce the number of back injuries in this province. We also target employers. We look at employers who would benefit most from our assistance. We call it the priority list now. We go and visit those employers together with the Industry Safety Association, if there is one in that particular industry group, together with Occupational Health and Safety, and we talk to employers about the importance of establishing a safety management system. We provide education and training. At the end of 2012, WCB assumed basically responsibility for all occupational health and safety training. So we do the Level 1, Level 2 HS training, the supervisor training programs, as well as many other training courses that we offer through the prevention department at the WCB. And of course, we run our awareness campaigns. Hopefully you've seen our ads on television, some of our newspaper ads, highlighting the Safe Worker and Safe Employers of the Year to create awareness around the significance and importance of injury prevention in this program. You know that talking to you about a reduction in premium rate to $1.46 is a little bit bittersweet for me, only from this one perspective. That we lose sight of the fact that there is a slight bump in time loss claims. And if we become complacent because premium rate has dropped for the 11th consecutive year, as Gord said, from $2.05 down to $1.46, it won't take very long for that trend to change. Premium rates will go up, employers will be unhappy. More importantly, or equally important, is workers will start getting seriously injured again. And so while it's great to be able to stand up here and deliver great news that the premium rate is dropping again, I am concerned that we not get complacent, we not back off from our investment in injury prevention in this province. Notwithstanding the decreases in the injury rate over the years, Saskatchewan continues to have the dubious honor of having the second highest time loss injury rate in the country. And if we look at injuries outside of the workplace, we look at all unintentional injuries, we are the worst jurisdiction in the province in terms of people getting injured, needing medical attention as a result of those injuries. So while I'm pleased to share this, what I think is great news with you, I'm also here to please ask you to continue your great investments in injury prevention and continue our downward trends in terms of reducing the number of injuries in this province. Looking ahead for 2015, needless to say, we're not going to back off on our injury prevention efforts. You're going to see as much or more of us in the future. Maximum wage increase is going up. Maximum wage base, I should say, is going up to $65,000 effective January 1, 2015. These are for new claims in the system. Gord talked to you about our vision statement and our focus on creating an excellent experience for our customers. We have made changes to underlying computer systems to support our claims processes. what I believe is necessary for us to sustain our results and continue to improve the customer experience is continuous process improvement. We need to look at the way we are doing our work in order to make it easier for workers and employers to actually deal with us and sustain the results in terms of reduced number of injuries and positive claim durations, and simply happier customers. Greater value to the customer for the same or fewer resources is ultimately what our objective is, and we have been for the last year and a half focused intensely on continuous process improvement. Unfortunately, as we're going through this process, some of you actually may have experienced less than great service as we make these changes to our underlying processes. We are working to rectify that as quickly as possible and give you new process to work in as early as January 1, 2015. Part and parcel of that continuous process is adding our online service ability, allowing you to find out about your claims, to report to us, to pay your premiums to us, to report your payroll to us online, so you don't have to do it between 8 and 5. You can do it when it's most convenient for you. And we're also going to do more expanded customer surveys so that we better understand what your needs are, what your expectations are. So through our continuous process improvement and other initiatives, we can strive to meet those particular needs and desires. Next steps. So after today's meeting, we will repeat a similar general meeting in Saskatoon tomorrow morning. And starting tomorrow afternoon, we will have industry-specific sessions scheduled. Those of you who have registered for those industry-specific meetings will know of the appointed times. Those of you who are not having industry-specific meetings, if you do have questions about your individual premium rate, how that's established, what went into establishing your premium rate, please contact our Employer Services Unit. One of our account managers will be in touch with you and arrange to meet with you or somehow explain to you really what went into the calculation of the premium rates. As you leave today, you can pick up a schedule at the back of the room that will show the premium rates for all industries on a comparative basis for 2014 and 2015. Our industry-based meetings will conclude at the end of this week. After that, we go into kind of a 30-day consultative period, an opportunity for employers and workers to provide us feedback on the assumptions that went into the establishment of the premium rate. A key part of this, if you haven't noticed yet, is the payroll. We're making, we think, conservative, but at the same time somewhat aggressive estimates in terms of payroll growth based on what you told us. We just need to reconfirm that 5.5% that we're assuming on an overall average basis, and it'll be different in your particular industries, is actually a valid number. The claim experience that we're seeing is actually what you expect to see moving forward, and so on and so forth. So by end of November, we will collect any and all feedback that has been provided to us during this consultative period. We will then feed that into the board in early December, get approval of the final premium rates, which will include any feedback that we do receive from you. Those rates will be approved at some point by early mid-December. Rates letters will then go out to individual employers, notifying them of what their premium rate will be effective January 1, 2015. With that, I'd like to turn it back to Gord.
Thank you, Peter. Again, I want to thank you for being here today, both of you, both people in the room and those who are joining us with the webcast. Before we start the discussion, your comments and questions, we want to share one of our WorkSafe videos with you. For the past 2 years, We've been conducting a targeted distracted driving campaign in the southeast and northwest areas of our province. When an economy grows, like it has been the past few years, the risk of injury grows as well. And we've identified traffic collisions as a risk in those areas. We are proud of the preliminary rates we shared with you today. We're proud of the injury prevention work we're doing through the WorkSafe partnership and the injuries that have been prevented since 2002. We are also very proud of our WorkSafe campaign. The video I'm going to show you was one of 30 videos featured in Germany this summer at the International Media Festival for Prevention, chosen from 290 submissions. So that's pretty cool, ladies and gentlemen. We were shown one of the top 30 videos of 290 submissions in a worldwide audience. We all have distractions when we get behind the wheel. Distracted driving is now killing more people than drinking and driving. The question we ask in this campaign is, what's your distraction?
There we go. How's that one? Oh!
About time. Where you been?
Sorry, guys.
At all of them?
Yeah.
He tore my hand!
That's okay. Okay, you guys. Okay.
The work that went into that video is really unbelievable. When I talked to the people at WCB as to how they made the video, the facts and figures that they put together to make the video, little things like at the beginning of the video, the camera's on the clock at 7:30 a.m. Well, there was actually some work done to have the time shown as correctly, so that it's not 11:30, it's actually 7:30, and little things like that. But the amount of work that went into that video, well, quite frankly, ladies and gentlemen, I was blown away. With that, ladies and gentlemen, I really want to thank you sincerely and truly for being here today, for your attendance, and for those of you online, for your attendance online as well, and for your questions from the online guests. But again, thank you so very much for being here. We value your presence, and we value your questions and your comments. So with that, again, thank you, and wish you a good day.